Right now, the stock market is trading at record highs. Everywhere you look, you see investor confidence pushing asset prices upward, driven by a deep-seated belief that we have somehow beaten the business cycle and that the good times will simply continue. We saw this exact same psychology in the late 1920s. Valuations stretched to extreme limits while the public assumed the upward momentum was permanent. And we watched the identical pattern repeat at the turn of the millennium. Tech stocks reached astronomical multiples, driven by the absolute certainty that the rules of economics no longer applied. Today, traditional metrics like the Buffett Indicator and price-to-earnings ratios are flashing red across the board, signaling extreme overvaluation in equities. But obsessing over stock prices means you are looking in the wrong place. The actual trigger for systemic failure is hiding deep inside the bond market, completely out of sight from retail investors. A highly technical anomaly known as credit spread inversion has reappeared in the high-yield bond market. We haven't seen this pattern in 17 years. The last time this specific mathematical threshold was crossed was the spring of 2007. Exactly 6 months later, the first major cracks appeared in the global financial system. This is a quantifiable measurement of systemic risk. The underlying financial foundation is fracturing, and the data tells us exactly how it's happening. To understand why this matters, look at this diagram showing how corporate bonds are rated. You have safe, highly stable companies sitting over here with AAA ratings. On the other side, you have risky, heavily indebted companies with BB or CCC ratings, often called junk bonds. Naturally, investors demand higher interest rates to loan money to those risky companies. That extra interest premium, the difference between the safe yield and the risky yield, is called the credit spread. Right now, that spread has violently collapsed. Data shows CCC-rated bonds are trading at spreads of just 6.8% above standard treasuries. Yields for nearly bankrupt companies are practically identical to the safest bets on the market. Investors are completely starved for return. They are buying the debt of highly unstable companies and accepting yields that offer absolutely zero mathematical compensation for the massive risk of default. You can think of this compressed credit spread as an artificial pressure mechanism weighing on the entire economy, a giant spring being wound tighter and tighter. Because debt is currently so cheap for risky borrowers, companies with terrible cash flow that should have gone bankrupt years ago are easily refinancing their obligations. These are zombie companies, kept alive purely by the collapse in credit spreads. Their survival creates a dangerous illusion of strength. They keep spending and operating, which tricks the stock market into rallying while the underlying financial rot continues to spread. The longer these zombie companies operate on life support, the tighter that economic spring is compressed. When the pressure finally releases, the snap will take the entire system with it. We currently have $10.5 trillion in corporate debt, the highest level in history. At the same time, inflation remains sticky, complicating the Federal Reserve's attempts to cut rates and relieve the pressure. You then have to combine this fragile, over-leveraged foundation with the highest level of global geopolitical instability we've seen in decades, from tension in the Middle East to Russia and US-China trade uncertainty. Markets are repeating historical errors by brushing off these massive external threats right at the exact moment the economic foundation is at its weakest. You have record debt, thousands of zombie companies, and escalating global conflict all converging. Right now, the market is sitting on a highly pressurized powder keg, waiting for a single match to drop. This line chart tracks our credit spreads. When an external shock finally hits, these low, compressed spreads will violently explode outward. The moment that happens, corporate credit markets freeze. Those zombie companies we talked about suddenly cannot refinance their cheap debt, triggering mass defaults, heavy layoffs, and an immediate collapse in consumer spending. We saw the brutal consequence of this sequence in 2008, when the blowout in credit spreads ultimately took down massive institutions and nearly collapsed the entire global financial system. Retail investors always get caught in the lag. Credit markets break first, but stock portfolios don't react until months later. If you think your equity portfolio is safe just because stocks are currently up, you are walking straight into the trap. Understanding this timeline gives you an advantage. It allows you to mirror the exact defensive moves institutional investors are making right now to protect their capital. First, build heavy cash positions immediately. When the panic sets in and assets drop by 40 to 50%, cash becomes the dry powder you need to buy at a massive discount. Second, rotate entirely out of the most leveraged, lowest profit areas of the market. Small cap indices like the Russell 2000 are filled with companies that will get annihilated when credit tightens. Third, identify the survivors. Sophisticated investors will target companies with bulletproof balance sheets and utilize inverse credit ETFs to generate massive returns while the broader market crashes. Just like in 2007, this mathematical signal has opened a brief window to prepare. Let me know in the comments if you are already moving into cash. Make sure to subscribe